Hey everyone, welcome back to Corporate Decoder. Today we're unwrapping a filing that involves a company looking to raise some serious cash, and let's just say they might be trying to sell us a little more than we initially bargained for. This is a report from Therapeutics Incorporated, and it is all about them filing a prospectus supplement. Think of a prospectus supplement as an update to a company's big sales pitch document, letting everyone know they're ready to sell more shares. So Therapeutics Incorporated, or Therapeutics Incorporated as they are known, are planning to sell up to a whopping $35.5 million worth of their common stock. This is part of what they call an at-the-market offering program. What that means in simple terms is they can sell shares whenever they feel like it through a designated sales agent, in this case, Oppenheimer and Company Incorporated. They've already sold a good chunk of stock based on a previous agreement, about $14.4 million worth. Now, they're essentially updating their paperwork to keep selling more. This new sales push will happen under a prospectus supplement dated the 28th of November 2025. This also ties into a larger registration statement they have filed, which is like a master plan for selling stock over a period of time. It's important to note that this filing itself isn't an offer to sell these shares, but rather information about their plan to sell them. They're also attaching a legal opinion from their lawyers, Lowenstein Sandler LLP. This opinion basically confirms that the stock they plan to sell is valid and legally allowed to be sold. This is standard practice to assure investors that everything is on the up and up. Now, what is interesting is that Therapeutics Incorporated is identifying itself as an emerging growth company. This is a designation in the US that basically means they are a smaller company and they get to follow a slightly less stringent set of rules for financial reporting, at least for a while. This allows them to defer adopting new or revised accounting standards. It is a way to ease the burden on younger companies as they grow. While this filing doesn't contain detailed financial tables that show revenue or profit figures, the core story here is about capital raising. They are looking to bring in more money by selling their stock. Companies do this for various reasons like funding research and development, expanding operations, or just shoring up their balance sheet for Therapeutics Incorporated, a company in what is presumably the biotech or pharmaceutical space given its name. This cash infusion is likely critical for advancing its pipeline and bringing new products to market. What we can infer is that the company feels it is undervalued by the market, or believes it has strong growth prospects that will justify selling more shares. Now, the fact that they are continuing with an at-the-market offering indicates a potentially steady demand for their stock, or at least a belief that they can sell shares at a reasonable price. Let's consider this from a Warren Buffett perspective. He often looks for companies with a strong competitive advantage and a clear path to profitability. In this case, the competitive advantage is likely tied to their intellectual property and the potential of their therapeutic products. The clear path to profitability is what this capital raising is intended to help build. However, without seeing detailed financials, it is tough to gauge the true health of the business. At-the-market offerings can sometimes be a signal that a company needs cash urgently, or it can be a strategic move to take advantage of favorable market conditions. The main risk here for existing shareholders are dilution. When a company issues more shares, the ownership pie is divided into more slices. This means each existing share represents a smaller percentage of the company. If Therapeutics Incorporated can effectively use this new capital to drive significant growth and profitability, the dilution might be a small price to pay. But if the funds are not invested wisely, or if their therapeutic development hits a roadblock, existing shareholders could see their investment's value get spread too thin. So, what is the takeaway? Therapeutics Incorporated is actively working to capitalize on its stock value to fund its future. The success of this strategy hinges entirely on how well they execute their business plan with the newly raised funds. It's a common move in the biotech sector, but one that always warrants a close watch on the company's operational progress and eventual financial performance. Alright, that's our quick decode of Therapeutics Incorporated's latest move to boost its coffers. What are your thoughts on this strategy? Do you think it is a smart move for the company and its shareholders? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and don't forget to subscribe for more corporate insights. Also, we have a fantastic community brewing on Discord, so join us there through the link in the description. Thanks for watching, and we'll see you in the next decoding.